Hi everybody, welcome back to Ox Talks. It's Wednesday, January 23rd, 2024. Hope you are having a productive day today so far. I appreciate you tuning into these shows and watching the channel. I also most appreciate each and every one of you subscribing to this channel. If you're here for the first time and you haven't subscribed, please consider subscribing. I hope that you will enjoy the content. I try to put something up here every day, limited to about 15 minutes max, sharing current events, things that are unfolding in our economy on a day-to-day basis. I throw in a sprinkling of discussing physical fitness, usually towards the end. And I always try to share a little tidbit about what's going on in my business. It doesn't really matter that it's a law practice. That just happens to be my profession. But it's more, the concept is, and what I'm trying to get across is the importance of owning and operating your own business to the extent that you can. And I've been doing this now for almost 30 years. I make my own hours. I pay myself. I'm not beholden to anybody telling me what to do, when to show up, how to do my work, when to take a break, when to eat my lunch, how much I'm going to get paid this week, how much I'm going to get in overtime. I control that. And it's empowering when you get to a place where you can do that and sustain yourself, earning revenue and generating income. It's not easy to do. I started off scrapping and clawing and doing everything I could do, overtime to try to generate and bring in business. If you're going to start a business, there was a comment this morning which one of my subscribers posted that I agree totally. If you're going to do it, you have to consider doing it without taking on debt. Start slow and work your way into the business and into the client base and into the goodwill. So again, thanks for watching. Please share the videos with all your family and friends. Hit the thumbs up button and the bell notification so you also get notice when the new content is posted, usually, like I said, every day. I have 3 good articles to share with you today. One touches on U.S. manufacturing in this country continuing to tank, falling off a cliff. The second article deals with the banks not only cutting credit lines, but tightening up their credit standards, refusing to issue credit because there's so much defaulting debt in this country from our consumers. And the third article deals with defaulting loans, multi-million dollar loans on downtown multi-unit apartment complexes that were planned, and now these borrower groups are simply defaulting. All 3 of these things are important because they make up the consumer segment of our society, the banking segment of the society or of our economy, and also the commercial real estate aspect. The first article is from Zero Hedge Today. I did a show 6 days ago where I reported on the data from the New York Fed manufacturing survey. And the information was that the New York Fed manufacturing was falling off a cliff. I forget what the exact number was, but it was like -47. All metrics were down. And the article concluded by saying, well, we'll see what is going to happen next week, which we're here now, with regard to the Philadelphia Fed manufacturing and now also the Richmond Fed. Well, today we got the information and it is not good. The story is entitled Richmond Fed Manufacturing Survey Crashes to Lowest Since COVID, and the Philly Fed services are also back into contraction. So it says the flashing red signals for U.S. manufacturing flashed redder this morning as the Richmond Fed survey showed manufacturing activity plummeted to -15, considerably worse than the -8 expected and to its lowest point since the COVID lockdowns, to the point when there was basically no manufacturing happening. Factories and businesses were shut down. So we're back to almost to that level right now, again, supposedly when everything is doing great. And by the way, that was a 100% miss. They projected it was to be down -8, and it was down -15, almost double. It says, under the hood was a you-know-what show, with new orders sliding further into contraction from minus 14 to minus 16, and employment collapsing from minus 1 to minus 15. It does say wages jumped, however. The capacity utilization index plunged from minus 8 to minus 27 in January, with about one-third of respondents reporting a decline in capacity utilization since December. And while a manufacturing recession, it says, is not breaking news, the narrative shapers can't just claim, well, services will support it. And 70% of the economy, etc. As the Philly Fed Services Survey slumped back into contraction also in January. So services sector is declining. Manufacturing sector is falling off a cliff. We need to be paying close attention to this. It's very bad. This is additionally, price indicator readings suggest continued increases in prices for inputs and prices for the firm's own goods and services. The prices paid index moved 2 points to 33.8. Over 36% of the respondents reported higher input prices. So the components are costing more. The orders are falling off a cliff because the consumers can't afford these things. So we're going to keep a watch on manufacturing in this country. It's a bedrock, and it is not looking positive. Second article talks about, we reported, I've done many videos on the level of consumer debt in this country. This talks about the banks. It says, as delinquencies spike, banks are granting fewer credit lines, Fed analysts warn. It says, with credit card delinquency rates at their highest levels in more than a decade, getting approved for a new line of credit is getting harder, the analysts warned. According to a new report from the Philadelphia Fed, which we just showed with regard to services, it says 3.19% of credit card balances were at least 30 days past due by the end of third quarter 2023. That's up from 2.76% in the second quarter and the highest level since 2012. And again, go back 2009, 10, 11, 12 and see what was happening. Just as concerning, the percentage of balances that were at least 60 days and 90 days past due shot up to the highest levels since the beginning of COVID. All stages of delinquency rates now exceed pre-pandemic levels for the first time, Fed economist Gene Huang and senior analyst Anna Velsker wrote in this report. And here's what they're calling, the banks are calling it a greater consumer fragility. As the Fed described it, makes banks think twice before granting new lines of credit. According to the researchers, banks' rejection rate today is the highest in the past year. And as defaults continue to rise, delinquencies continue to rise, the banks are going to keep constricting this credit. They're not going to be handing out these credit cards and these HELOCs and these lines of credit that they were at one time. So credit's drying up, folks. We've been hearing that for a while now, and the consumers are as fragile as ever. It says CFRA bank analyst Alexander Yoakum adds that rising delinquencies aren't a big deal with, quote, unemployment under 4%, suggesting that Americans will continue to make payments so long as they're employed. And that's the operative words, so long as they're employed. We also know that layoffs are continuing to accelerate into the latter part of last year and the beginning of this year. So again, everything is on such a hair trigger. If people lose their jobs, they can't make that credit card payment. They can't make that auto loan payment. They can't make that student loan payment. And guess what? Those will reflect negatively. Even a 30-day delinquency will bring down your credit score. And good luck then applying for or obtaining any kind of credit in the future. It says Credit News has recently reported on a sharp rise in auto delinquencies, especially among subprime borrowers. In September, the percentage of subprime borrowers who are at least 60 days behind on their car payments increased to 6.11%. The highest since at least 1994. So again, guys, we have to go back 20, 25 years to see, at least 20 years to see times that were this bad. And again, everything is getting compared almost daily now to the great financial crisis period of time. So this is incredible. I hope it's eye-opening to everybody. I don't think it comes as much of a surprise to the people viewing and watching this channel. We'll continue to report on it as this stuff unfolds. It seems like the onslaught continues on a daily basis. The last article I want to share, this talks about the commercial real estate sector in Los Angeles. It says it's apartment towers. It says Realm and Bascom Group default on $33 million loan for LA apartment tower. And this is out of the Commercial Observer today. It says financial distress in downtown Los Angeles has extended beyond the office market. It says Realm and Bascom Group defaulted on a $32.9 million loan tied to a planned 36-story apartment tower developed in the beleaguered LA district, according to reporting by The Real Deal, which cited county records. County records means there's a notice of default's been recorded, most likely on the property for them failing to make their loan. The next step after a notice of default gets recorded in California, there's a 90-day waiting period, and then the foreclosure sale can be scheduled. Notice of sale can be published, recorded, and the bank can sell the property. It says Terracotta Group provided the loan in 2021, which refinanced an initial loan on the project provided by Starwood Capital Group. The development, and here's another one, the development at 675 South Bixel Street, named Bixel Tower, calls for 422 units and a 4,900 square foot commercial space. Realm and Baum acquired 7 land parcels for the project in 2019 for $28.6 million per the foreclosure report on the project. Now it says foreclosure cannot be arranged until at least February 28th per the state rules. The tower is listed for sale with no listed price. Realm is also planning to build a separate 33-story, 452-unit apartment building in downtown LA's Fashion District at 222 East 7th Street. The Orange County-based companies are far from the only ones missing payments, it says, on large projects in Southern California. Investment management firm Brookfield defaulted on over $1 billion in debt tied to 3 downtown office towers earlier this year. Meanwhile, TA Partners defaulted on nearly $200 million in loans tied to 2 apartment buildings in Irvine in October, while Walton Street Capital and Greenlaw Partners in November missed payments on a $63 million loan tied to an office tower in Orange, California. So we have this collapse now extending to a multi-unit apartment complex loans. And look at the reality is the value of these properties is dropping so much. It's not even that the business plan doesn't make sense if the value in the buildings were there. But they're looking at having these loans on the books and then contemplating whether it makes sense to incur the extra millions of dollars for build-out costs, given the value. Some of the stuff has probably dropped at least 50%. So I hope those 3 articles, bring this into perspective today. They run the full gamut of sectors of our economy that are all getting destroyed. With that being said, I'll leave it there. Not much to report today from the business. I got all my arbitration materials submitted to the arbitrator that I mentioned in yesterday's video, and I'm going to be leaving here in about an hour or so to get my workout in today. It's a leg workout. It's probably my least favorite. Guys always hate leg workouts for the most part. Well, a lot of them do. So I struggle through leg day, but I'll get it done. There's no days off. We just keep going. Stay fit. Please get your steps in today. Do some walking, whether it's even 15, 20 minutes. Try to get some strength training in within your physical abilities. Stay hydrated. We need to continue to improve our physical fitness. The diet aspect, I'll hammer this every day. It's more crucial than the exercise component. If you're not watching what you eat, in connection with a good physical fitness regimen, it's going to be hard to make progress. Trust me, I've been on the other side. It's you have to be like everything else in life. You have to be. You have to show up. You have to be diligent. You have to have a routine, and you have to stick with it. With that being said, appreciate all of you watching once again. See y'all tomorrow. Bye.